So today ReCM is well known for having quite a heavy weighting of resource and mining stocks in our client portfolios, and we've come in for quite a bit of criticism for that positioning. But I think to understand why we are positioned that way today, I think one has to just go back into history and have a look at where we've come from. So if one rewinds the clock back to 2007, 2008, at the height of the whole commodity supercycle story, the Chinese boom, one can see that mining stocks at that time were very popular. Most investors had a lot of exposure to that sector based on the whole positive growth story in China. And these stocks were very, very expensive. The price to book ratios were elevated, the PE ratios were quite low, but that was based on very high earnings. We like to look at price to book ratios, and those were extremely elevated, which indicated to us that these stocks were overvalued. At the same time, the executives in charge of those companies were or had drunk the Kool-Aid as well, and they also believed in this whole Chinese growth story that would carry on forever, or so they said, and they were acquiring assets in the resource sector at very high prices. So this was an environment which made us very uncomfortable, and we stayed out of it. Again, at that time, we came in for a lot of criticism for not owning the resource stocks. Then we had the global financial crisis, and these stocks, of course, as everyone knows, collapsed. Our clients' portfolios actually did very well throughout the financial crisis because of the fact that we didn't own these highly valued, very expansionary stocks. So what happened subsequent to that is that all the CEOs of these companies have been replaced. Mark Cutifani has replaced Cynthia Carroll at Anglo's, Sam Walsh has replaced Tom Albanese at Rio Tinto, and Andrew McKenzie has replaced Marius Kloppers at PHP Billiton. And of course, these replacements happened after the previous CEOs were fired due to massive write-downs of the assets they had acquired during the massive bull market in resource stocks. So where we sit today, we have new CEOs who are incentivized to cut costs and to cut capex and to generate cash flows. That is their job, and that is what they're talking about. So the strategy being applied to these companies today is very different to the expansionary strategy that was applied during the boom times. And we think the strategy being applied today is very sensible. So as owners of these stocks, we find that quite attractive. Of course, this pro-cyclical approach to the sector by these large companies is what gives rise to the commodity cycle in the first place. When they go through tough times and they cut back capex and they cut costs, that means because of the long lead times that it takes to produce commodities, that means sometime in future there's going to be less of these commodities being produced because they're cutting back on capex today. Just like today there's a lot more being produced due to the expansionary policies of 6 to 7 years ago. That is the root of the commodity cycle. So what we're seeing today is the seeds of the next upturn being planted by the executives in charge of these companies through the fact that they are cutting back on capex and cutting costs. And we find this quite interesting. Of course, the third thing that has happened is that the valuations of these companies are very, very attractive. As opposed to 2007, 2008, when the valuations were extremely elevated on the back of a good news story around China and the commodity supercycle. Today there's bad news around strikes, there's bad news around costs, there's bad news around asset write-downs. And as a result, the valuations of these stocks are depressed. So as value investors today, we're sitting with a very positive trifecta of events in the resource sector. We're sitting with chief executives companies that are doing the right things, doing the sensible things. We're sitting with the seeds being sown for the next upturn in the commodity cycle, and we're able to access this turn of events at very low valuations. And for us, this makes eminent investment sense.